But Prashant, I think the top story that we're covering on Trading Hour is that there has been a lot of focus on India's technology landscape, particularly the listed ones like Zomato, Nazara, or these new age digital companies. And today you will be comparing how the valuations, the growth prospects of these companies stack up vis-a-vis the global peers, because now Indians have an option to invest directly into these overseas companies as well. So take it away.
Well, thanks very much for that. There has been a huge amount of focus over the last several months on the opportunity that global stocks offer and how it's becoming easier and easier for Indian investors sitting here to be able to buy global businesses. I decided to take a look at one specific sector, new age tech/digital/internet businesses. In the listed space in India, they are a fairly recent addition with many new ones lined up to go public. But globally, they have been the dominant drivers of equity indices in US, in Europe, even in China and elsewhere. Let's compare what is on the menu as far as internet/platform companies go, local versus global. All right, so this is the universe we're going to be comparing. Before we get into financial comparison, etc., let me quickly do a size or market cap comparison. Right? Actually, there is no comparison, and that's essentially precisely why I wanted to put these numbers out. Indian versus global. The average market cap of the companies that you see listed here on the Indian side is 3.87 billion US dollars. And this is thanks only largely to Zomato, which has a market cap of over 1 lakh crores. You take Zomato out of the equation, the average number falls dramatically. The global companies on this side of the screen here, on an average, the companies, I'm only talking about the companies which I've listed here, have an average market cap of $759 billion. 3 companies here in this list have a market cap greater than $1 trillion. So keep this size differential in mind when we look at the rest of the numbers. Now here is a look at the revenue CAGR over a 2-year period. I mean, fairly recent, but I think it should give you a fair idea. As you can see, on the Indian side, Affle and Nazara have seen the biggest growth. On the revenue side, Zomato is at number 3, out of companies that I've put here on the board. This is the listed space, of course. Compare this to global giants. The top 3 trillion dollar plus companies have grown revenues over the last 2 years at between 20 and 30%. Chinese internet giants like Alibaba and Tencent are also growing their revenues at between 20 and 30%. DoorDash, comparable to Zomato here, is growing revenues at nearly 40%. Well, this half of the screen, for the size that they offer, isn't looking all so bad, is it? What about net earnings? I'm talking about EPS. The 2-year earnings CAGR amongst the India-listed internet companies is there for 3 companies. I mean, the others, we don't have estimates because, they're still yet to turn a profit. Look at the global firms. The top valued nearly $2 trillion internet giant Alphabet grew revenues over the last 2 years at a CAGR of 37%. Amazon grew its earnings at 15%, Facebook at nearly 30%. This is simply incredible if you think about it, to grow earnings so aggressively at that size. It's just something else. Next, we come to valuations. Based on 2022 earnings, FY22 here in this case, is there a stark contrast? Well, India Internet, based on P multiples, is not cheap. And I think it's fairly well known. The numbers are all here, as you can see. But what about the global internet giants? Well, it's actually dispersed. The number 1 and number 3 companies here on the board in terms of market cap traded around 20 times earnings, while the number 2 company by size here, which is Amazon, trades at over 40 times earnings on a P multiple basis. So net, what do we take away? The biggest eye-opener is that mega global internet companies are growing revenues at a fairly fast clip at their huge scales. Not just revenues, but net earnings as well is very robust. Now remember that these giants offer leadership in some of the largest and most profitable markets globally. Amazon, for example, is the 2nd largest US retailer. Actually recently outdid Walmart, but for a brief period. Amazon has a 39% e-commerce share in America. Coming to India, the consumer internet space has been growing very fast. The average growth rates for Indian internet companies is now almost 100% compared to pre-COVID levels. If you look at gross transaction value, GTV, the most commonly cited metric for these companies, in the Indian context is seen reaching about $185 billion by FY25, which will be 3 times of what the actual number was for FY21. Also, while as of now in India, e-commerce contributes 64% and 44% of the estimated transaction value and profits. But that's the situation right now. But profit pools, remember, apart from e-commerce, are also expanding in segments like food tech, ed tech, B2B businesses, and so on and so forth. So, I mean, all in all, are you better off buying established global internet giants as compared to Indian emerging businesses in this space? Well, there is no one right answer. You can argue it out both ways. The point for me to put this piece out was just to remind you that there are options available in the internet space. You don't necessarily have to pay nosebleed valuations to get exposure to these internet plays. I mean, that's the point as far as this piece is concerned. We have actually, 2 guests joining us who are experts in this field. We have Sudhir Guntalapalli, he's lead analyst technology sector at ICICI Securities. We also have Rajiv Thakkar, he's chief investment officer and director at Parag Parikh Mutual Fund. Their fund owns lots of these global internet giants, especially in the US. Gentlemen, thanks very much. Great to have the both of you here on the channel. Let me just ask the question, Sudhir, to you first. Does this comparison, just asking the question make sense? India internet versus global internet. There is no comparison as far as size is concerned, but what we are interested in is the growth rates at those scales and the valuations which look fairly reasonable as compared to what is available here. Sudhir, you go first.
Yeah, Prashant, thanks for having me here. And it's a good debate that you have started off. But now let me kind of highlight 3-4 pointers over there. When you are making those comparisons, I think it's good to keep in mind certain critical pointers over here. First and foremost is you should understand at what stage of evolution each of these companies are in, right? Depending on that, obviously, growth rates, margins, PE multiples, PAT margins, everything will look very different. So if a company is just starting off, let's say if it is a 4 to 5 year old company, obviously it will not be having profits. Accordingly, your PE multiples, price to sales multiples, PAT margins, ROEs, everything will look very distorted when you are comparing it with, let's say, an established company like an Alphabet or an established company like Facebook, which has been in existence for last 20 to 30 years. So the differential in terms of the stage of evolution of the companies has to be kept in mind. Second thing, when you presented the recent growth numbers, so on and so forth, another point we should keep in mind is that COVID had differential impact on different internet companies, right? The impact is not symmetric across different types of companies. Let's say some companies like Amazon and Facebook had seen very strong increase in, let's say, user engagement, acceleration in growth, so on and so forth over the last 1.5 years. Going forward, they're expecting those growth rates to decelerate. On the contrary, if you want to contrast it with, let's say, some of the Indian companies like Zomato, because of the more stringent lockdowns, more severe restrictions, etc., these companies had actually seen a decline in revenue in the last 1 year, and they expect a very sharp rebound going forward. So that is the second differential that we should keep in mind. The third differential is the regulatory aspect, right? If you look at Indian, regulatory paradigm around internet companies, we would personally believe that it is one of the most conducive regulatory paradigms across the globe. We have seen what happened with Chinese internet companies, and even outside China also, if you see, even in very developed countries like US and UK, there have been strict regulatory scrutiny around most of these tech companies, which is not the case with India. In India, we have very open and free market sort of a regulatory paradigm across the internet companies. So these are the 3 differences that we should keep in mind when we are doing this comparison. Otherwise, it's a great debate to start off with.
Rajiv, your first thoughts on what we're discussing?
Sure. So Sudhir has covered a lot of ground in his opening remarks. I'll just add on that and really build on that. So firstly, you may be able to compare a Zomato and a DoorDash to some extent, but comparing a Zomato with a Alphabet or a Facebook does not make too much sense in terms of comparing valuations, etc., or growth rates, because they are in different segments. Number one, the vintage of the company is different. Some of these companies have started long back, and they have established business models. So one has to keep that in mind. I think the important thing for a Indian investor who's looking to invest in internet businesses is that one should keep in mind that it is early days yet. So while the base is low and the growth rates look very, very good, but it's an evolving space. And to some extent, I am not as sanguine as Sudhir in terms of the regulatory aspect, because in my mind, that is a developing space. So we have seen the antitrust investigations against the likes of Amazon and Flipkart being started in India. There have been pushbacks from restaurants and other people in terms of what is the cut that the food delivery companies can get, or media articles about the pay scales of the delivery partners that they have. Even ride-sharing companies like Uber and Ola in India, whether the drivers are employees or not, that debate has started in the Western countries. I think it's a matter of time before those kind of things start coming here as well. So while the base is low and the growth rates will look very, very strong coming off that low base, what one has to keep in mind is that these are nascent businesses, and the mortality rate in nascent businesses is relatively higher as compared to more mature businesses that we see, the trillion-dollar companies that we see in the Western markets. And the other thing that many times get missed, and a lot of media articles have been written on this aspect, is that while the number of mobile subscribers and the number of internet users in India are large, you may have, let's say, 40-50 crore internet mobile users, but the monetizable population where you can make meaningful revenue generation from those users, that currently is at a very low level. Estimates range from around 3 crore users to 5 crore users, depending on the category that we are looking at. So looking at the entire 50 crore internet user base may not be the right way of looking at the near-term potential, at least. And when I'm saying near-term, next 5 years, 6 years, it may not be a very large market for some of these businesses.
Gentlemen, morning. This is Rima here. Sudhir, I wanted to get your thoughts in on 2 points. Right now, the Indian internet companies on the listed side are awarded a scarcity premium. But do you see that scarcity premium valuation coming down as more and more companies are IPO bound, and in that sense, it is a risk to the valuations that they're currently accorded? And secondly, amongst the listed players, which of them offers the optionality that Amazon does? Which means today, Amazon gets more than 50% of its revenues from AWS. It gets it from Prime Music, Prime Videos, Music, etc. So amongst the listed Indian companies, which companies offer that optionality, which then in a way can support its valuations?
Sure, Rima. Couple of points. First, in terms of the scarcity premium that you asked, you were right. Earlier, when the likes of Zomato, etc., were not listed, there were very few listed internet companies like, let's say, IndiaMart, Apple, so on and so forth. So their valuations were baking in a big scarcity premium. Accordingly, now as the supply comes into the markets, as the internet stock supply comes into the market, more and more internet companies get listed. It's a fair assumption to take that the scarcity premiums will go down. Right? Accordingly, we believe that some stocks may see some impact in terms of a derating, either a time correction or, let's say, a stock correction as well. So definitely, yes, the scarcity premiums will go down as more and more good quality internet companies get listed and the internet supply increases in the market. And on the second point, in terms of the optionality premium, We had recently, yesterday, we had come out with an initiation report on Zomato, where we had highlighted that we are not building in any optionality premium into the valuations currently. Because it's very difficult to actually, let's say, factor some optionality premium at this juncture. Of course, the company has very good adjacencies where it can enter into. Company is already invested into Grofers, where it currently holds around 9% stake, and it's already into, let's say, Hyperpure. It's already into, let's say, advertising, Dine Out. I think 3 or 4 other businesses are currently contributing around 25% of the revenue, and there is a good amount of scope for the adjacencies share of revenue from adjacencies to increase going forward. But at this juncture, it is very difficult to factor that into target multiples and target valuations. So we are not factoring in any optionality premium at this point. But most of these businesses, one thing you should note is that the scalability into adjacency is very easy for them once you have the backend operational infrastructure in place and once you have the customer engagement on the app. So if you have both on the front end, once you are engaged with the customer, on the back end, you have operational muscle. It's very easy for, let's say, the likes of Zomato and Swiggy to get into adjacencies, be it hyper local delivery or, let's say, concierge services, so on and so forth.
Okay, Rajiv, just one final question. You spoke about, since the Indian industry is at a nascent stage, there is a mortality rate which could be on the higher side. Is that a risk for the listed players as well, or is it only for the unlisted players? Because you don't want to invest in, a company which is listed and then you see 2, 3, 5 years down the line, it goes bust. So can you talk about the mortality risk for the listed players? Or do you think once they're listed, they are fairly mature and that risk is on the lower side? And finally, coming back to the question that all investors want to know, where would you invest? Would you invest in these Indian, listed digital new age companies, or would you go global?
Sure. So the mortality risk is more for a small startup, and it goes down as the company becomes bigger, as the financial strength of the company increases. Because there is this terminology that companies in this space use. They refer to a term called pivot, because whenever regulations change or the market dynamics change, they have to change their business strategy. So if you look at one other company, for example, which was offering financial wallets where you would put money in the wallet and then make payments, that company had to pivot from a wallet model to a UPI model because the market infrastructure changed. So while the company which is listed may have financial strength, but the business model that we are evaluating today may no longer hold true down the road. So all the revenue estimates and profit estimates that we make, those will remain at risk, even if a company were to get listed. So we are very excited by the listings that are happening in India and the IPOs that have already come and the IPOs that have been filed. So now we have the good situation where these companies are listing in India rather than MakeMyTrip and Yatra having to go abroad to have a listing, or a Flipkart which never got listed and got sold to Walmart. So it's a good situation for India. But for now, we are just watching the space. Most of our investments, or rather all our investments in internet businesses, are in global companies. We are yet to begin in the Indian markets.
Rajiv and Sudhir, it's great speaking to the both of you. Appreciate your time here on CNBC TV 18. Good discussion, gentlemen. And I mean, a discussion we will continue having as more and more companies make it to the public markets. And it's a long list. There are a few listed, as I outlined earlier, but the list of the ones which want to go public is even longer. 48 points on the Nifty right now, 60.